Now, so what are the transmission channels? And some of the things that I will say are kind of obvious, but let's think about the transmission channels that are at work and how this financial crisis is likely to be transmitted to the real economy. And when I do this kind of exercise, I always like to put myself in the position of a firm. Okay? Imagine that you own a firm, you're managing a small firm that produces a differentiated good. What will make you decide to produce less? What will make you decide to fire some workers and so on? Okay? So here are some of the channels, maybe in chronological order in terms of when they started operating. Residential investment. I mean, the decline in residential investment has been huge, as you know, and I think that the main force, there are two main forces here. One that is very important is the expectation of price declines in housing. I mean, who is going to buy a house unless that person really needs to because of the person had just moved or whatever, who's going to buy a house if everyone is telling you that prices are going to decline by 20% over the next the next 1 or 2 years, no? Obviously, there has been also a tighter access to credit. More on this later. Consumption. Well, certainly the consumption will be affected by the strong negative wealth effect coming from the decline in the price of houses to begin with, and also the decline in stock wealth. Okay, that should affect consumption. Quantitatively, all the estimates suggest that the elasticities are relatively small. There is another, I think there is another channel that is at work in this likely downturn, which is the increase in precautionary savings. Okay, all our models say that in response to an increase in uncertainty, consumption should decline, savings should go up. I think this is already showing in the data, both in the US and Europe and in Spain. Business investment also likely to decrease because capacity utilization will be lower as a result of the decline in demand coming from these other sources, and also tighter access to credit. And exports, which sometimes is the last refuge of an economy who is going through a difficult domestic times. Well, exports are not likely to help this time around because this is likely to be a global recession. Now, what is the role that financial intermediaries may play in this recession, or financial intermediation may play in this recession, and why it may make it worse? Okay, and here I have listed two well-known sources of the so-called credit crunch. Okay, first there is a deterioration in borrowers' balance sheets, and this comes from the decline in the prices of housing, the decline in stock wealth, and so on. That implies that, well, they have less collateral that they can put on the table when they negotiate with banks, and that means that they will have less access to credit. At the same time, that there is a deterioration in lenders' balance sheets, in banks' balance sheets, coming from their cumulative losses resulting from the poor investments they've made, and that if they want to restore their capital, well, that will require, as I think it was both Jose and Xavier were saying, some deleveraging. Either you raise capital, new fresh capital, or you have to sell your assets. And the last thing that you will do in that context is, it's hard enough to sell one's assets. So the last thing you want to do is to expand your assets, so that you don't want to increase credit anymore. Okay, and this in turn will have feedback effects. I mean, to the extent that the economy really plunges into a recession and unemployment increases, which it is already increasing, and so on, that will only worsen borrowers' balance sheets and worsen lenders' balance sheets, and so we will enter a vicious cycle. Okay, and just to conclude these thoughts, let me just give you some evidence. There's a whole literature in macro that looks at the role that financial intermediation and distortions in the workings of financial markets may have played in economic fluctuations. And this is some pictures from the most recent World Economic Outlook report that the IMF publishes, and I think it's an interesting exercise. So what the IMF has done is to look for 17 advanced economies to look at, I think it's more than 100 episodes that they call episodes of financial stress over the past 30 years. Again, I cannot get into the details now, but they compute a financial stress index, and if that index goes above one standard deviation of the trend, they call that a financial stress episode. That's, I think, a very too generous definition, so that is that it includes too many episodes, but no, that's the way they've done it. So here you have all the episodes, 113, and of those financial stress episodes, we can see there something that it's interesting. Many were not followed by either a slowdown, there is a reduction in growth, or a recession, a decline in the absolute level of economic activity. But many were followed by such a slowdown or recession. But of course, that may be the result of this generous definition of a financial stress episode. So let's look at this from a different point of view, which I think is more interesting. Now let's take all the recessions and slowdowns, let's concentrate on the recessions that these economies have experienced over these 30 years, okay? So you can see, and let's look at the cumulative output loss during those recessions, okay? So you can see that those recessions that were preceded by an episode of financial stress were characterized by a cumulative output loss that was considerably larger, twice as large, as the recessions that were not preceded by financial stress, okay? So this suggests that financial stress or episodes of financial stress, if they end up having an impact on the real economy, that impact is likely to be very large, okay? And one more figure that I want to show you. These are initial conditions, okay, that characterize periods of financial stress, okay, when they generated recessions, slowdowns, or neither, okay? So just summarizing, the episodes of financial stress that have led to serious recessions are the ones that were characterized at its beginning by a large increase in household net borrowing, okay? This is something that we have seen in the current episode. By a large increase in non-financial corporate borrowing, that's not something that has characterized so much this recession. In fact, the corporate balance sheets until recently were, non-financial corporate balance sheets were pretty healthy. Also, they have been characterized, the ones that have led to strong recessions are the ones that were preceded by large increases in real house prices. Clearly, this is the current episode is an example, and by large increases in credit, in which again, once again, this is the current episode is an example. So, if we look at and I'll finish with this. If we look at the historical experience of the past few years in advanced economies, and we compare it with the current episode, the characteristics of the current episode point to the very likely start of a serious recession. Thank you.
Okay, thank you very much, Jordi.